In this video, I look at a weekly trading strategy that shows a significant advantage over buy and hold. I will show you exactly the strategy that I am using, and I will show you how you can do this analysis too. I've thought for a while that Alexander Elder's impulse system will work well on the weekly time frame. And what I found out is that it does, but you have to choose the right market. So here on the screen, I'm showing what the strategy is. Now, a quick recap. The impulse strategy is a combination of two indicators. It combines the EMA with the MACD histogram. So the EMA is there to identify the recent to short-term trend, and the MACD histogram is there to identify the recent momentum. If both of these are pointing upwards, in other words, the EMA is going up and the MACD histogram bar is higher than the previous, then we have an up impulse. If both of them are down, then we have a down impulse. And if they're not saying the same thing, then we have no impulse. This is a very particular type of indicator. It's really designed for momentum markets, and that's exactly what I have found. On the screen at the moment is how I tested this strategy. This is a trade-informed backtest model. It is built in Excel, and you can use it to test all sorts of different trading strategies, all sorts of different time frames, from the weekly time frame down to intraday time frames, and all sorts of different markets. If you'd like more information about backtesting in Excel, which is a very accessible way to do it because you're already familiar with the software, there is a link on the screen and more information below about how you can get a trade-informed model. So let's look at some of the assumptions here. So I'm testing the Nasdaq 100, and I'm using a long time frame. Testing it all the way back, time period, I should say, back to the early 90s. 1992 is when we started the analysis. Now I'm using a percentage-based profit target and stop loss. I'm showing you at the moment 50% profit target with a 20% stop loss. And we can adjust this in real time, and you can see the model adjust. So we're not necessarily using this to optimize it, but we are looking to get a feel for the sort of range of the parameters that we should be using in our strategy. If you don't do something like this, it is more difficult. Get a feel for the range, the reward to risk ratio, and you can see the results change in real time. And try a stop loss. See how it affects. Try a trading stop, I should say. Okay, so these are the conditions for the impulse indicator. 11-week EMA, standard settings for the MACD, and there's our linear regression filter. And we can see here, as we adjust the profit target, stop loss, and the entry filter, the linear regression, we can see things change. I've got two lines here on my chart, one of which is buy and hold, you can see here in red, and the other of which in the green color is the strategy. So we don't have to have buy and hold on the chart. But there we go. So we can test different things. This is the beauty of once you have your strategy, you can test different things. So I'm using an impulse signal of 1, which means both indicators pointing upwards. That's what it would look like. Everything the same except an impulse, except no impulse, pointing in different directions. -1. That's what it would look like if we were using an impulse, a negative impulse. So I'll switch it back. It's always worth looking at the opposite conditions to see what insights it brings to the strategy that you're testing. Now I've got two other types of closes which I have been working on for a while and I really like. They're not going to work in every strategy, but they are an addition to or an alternative to using standard profit target and stop loss, which I also like. So strength close. What I call the strength close. Consecutive bars of profit. So 2 consecutive bars of 4% profit. Very easy to manage. If you're keeping an eye on the market, you have a 4% gain in a week, 2 of them in a row, then you can close the trade. I've got another one here. If the trade is losing, don't forget your psychology is completely different when you have a winning trade to when you have a losing trade. And I'm talking about an open trade here. If you have a winning trade, we think one way. We all know what that is. If we have a losing trade, we think another. We're becoming a lot more fearful. Will this trade go worse? Often, it's a good idea to have a different way of exiting the market depending on how the trade is going. So this is a way of doing that. And you can see we can set a lower criteria for getting out of that trade if it is currently negative. So it would require just 2 consecutive bars of a 1% gain. Let's have a look at those results. Well, there are a lot of different scenarios where this strategy was profitable. And I often want to compare the MAR ratio as being a fairer way to compare things over time, because the MAR ratio takes into account maximum drawdown, which is a crucial aspect. So the Nasdaq, for all its very high gains, has had some very high drawdowns. 82%, which occurred during the dot-com crash. Who knows whether it will do that again, but it does put into perspective the annual gains. Now, the trading strategy we have here, even though it's just a small bump here, shows that it underperformed during the dot-com bubble, but it has overperformed for most of the time period since then. So we can see that consequently it has a higher MAR ratio here, 0.53 compared to 0.17. There's lots of different scenarios that this strategy will work. Taking out these strength closes here, we can see it works pretty well on its own, and it's got a good high MAR ratio. We're not always wanting to optimize for the best annual growth rate because we're only looking back. We need to look forward as well, and the way to find out, to get the best idea about what will work in the future, is looking at a range of values. Look at the stability of the values. So we could do that. Let's do that now. In fact, we've got an optimizer in this model as well, which is really easy to use. So let's have a look at our stop loss. So initial value of 5, step value, how big a step to use in your optimizer, and a final value. And then we click optimize. So it's going to run through very quickly the range of values. And I'm actually optimizing for MAR ratio here. You can see it goes to 15. If I was to optimize for net profit, I get a slightly different result. So we can have a look, take that information, bring it back into the model. So see here, we've got a MAR ratio slightly better, even though we have some big drawdowns in more recent years using 15, but at 20, those drawdowns occurred in earlier years. And so we have a higher net profit. So the optimizer can very quickly give us information that it may not otherwise be obvious to us. So you can see that the model results are pretty stable. Take the linear regression on and off, and it does change the profile of the results. We get more trades. We would expect to get more trades without this filter. So there we have the results of the strategy adjusted in real time. As I said earlier in this video, if you would like to have this model or a model similar that you can use to test your strategies, check out the link below. You might want to become a Trade Informed member and get one of these models every month, or you may want to purchase one from the Trade Informed shop. I hope you enjoyed this video and it gave you some useful and actionable information. If you did enjoy the video, please hit the like button. Please subscribe to this channel for more content like this. And if you'd like more information about trading the financial markets, about analyzing trading strategies, please go to tradeinformed.com.